Imagine this. You find a stock that looks cheap, the chart is quiet, and you think, no one has noticed this yet. If it goes up, I'll make a massive profit. Sounds exciting, right? But before you jump in, pause for a second. Ask yourself one simple question. How liquid is this stock? Low liquidity stocks are like empty roads at night. Hardly anyone is buying, hardly anyone is selling, and price doesn't move smoothly. Instead, it jumps. One big order can push the price up or crash it down, and that's where most traders get trapped. On the surface, it looks peaceful, but underneath, it's actually a dangerous game. When liquidity is low, the bid-ask spread becomes wide. That means the price buyers want to pay and the price sellers want to accept are far apart. So even if you buy at market price, you might already be losing money the moment your trade is executed. You don't get a fair price, you get whatever the market gives you. And trust me, that difference adds up. Another big problem? You can't exit easily. Entering a trade is easy, you just click buy. But what happens when you want to sell and there's nobody ready to take your shares at your price? You either wait helplessly or you drop your price lower and lower just to get out. By the time your order is filled, your small loss may have turned into a big one. In low liquidity stocks, you're not really trading the market, you're negotiating with a handful of random buyers and sellers. And let's not forget manipulation. Low liquidity stocks are playgrounds for pump and dump operators. With very little money, someone can push the price up dramatically and make it look like the stock is flying. Retail traders jump in, thinking they found a hidden gem, but once the operators book profits, the price collapses, and the late buyers are the ones left trapped. Charts look beautiful on the way up, but reality hits when there are no buyers on the way down. You'll also notice that technical indicators behave strangely in illiquid stocks. Breakouts don't mean much. Support and resistance levels don't hold for long. Candles look irregular and jumpy. That's because real price discovery isn't happening. There isn't enough participation for reliable patterns. So strategies that work on liquid stocks suddenly fail here, and traders think the problem is their strategy when the real problem is liquidity. There's also a psychological trap. Traders see a low-priced or thinly traded stock and think, I'll enter early before big players discover it. But here's the truth. Big players usually avoid low liquidity because they simply can't enter or exit large positions smoothly. So if institutions aren't touching it, ask yourself why you are. Risk management becomes extremely tough too. You might set a stop loss, but in a low liquid stock, when price gaps down, it doesn't trigger at your level. It jumps right past it. You don't get the exit you planned. Your loss becomes unpredictable. And in trading, unpredictability is your biggest enemy. So what should you do instead? Always check the average daily trading volume. Look at how many shares are traded per day. See how quickly orders get filled. Notice the bid-ask spread. If the spread is wide and volume is thin, consider stepping back. A good trade isn't just about direction. It's also about whether you can enter and exit easily. Remember, trading is not about chasing every opportunity. It's about protecting your capital first. Liquidity is like oxygen in the market. Without it, even the best-looking trade can suffocate. Many new traders don't lose because they were wrong about direction. They lose because they couldn't exit when they needed to. So next time you see a quiet, low-volume stock that looks attractive, don't rush. Think twice. Ask yourself, if things go wrong, how fast can I get out? If the answer isn't clear, maybe that trade isn't worth it. Smart traders don't just look at price. They look at liquidity, volume, participation, and risk. That's what keeps them in the game long term. Think twice before entering low liquidity stocks, because sometimes the biggest trap in trading isn't the market, it's the trade you thought was harmless.